There was another error in her compensation in which she should have really only been paid 1 day, and she was paid for a week. That resulted in an overpayment of $3,215. We were provided a copy of the new executive director's employment agreement. We did determine after one-on-one meetings with the authority board members that at least 5 of the authority board members stated that they were not presented with that contract at the meeting when it was supposedly adopted. And as a result, as an opinion of legal counsel, with which we concur, that contract is not enforceable because it was not voted on in accordance with the Government in the Sunshine Law. Although her contract wasn't valid, there are several things that were in that contract that really were paying more money, allowing for more vacation, allowing for severance. There was a lot more generosity in that contract than there was in the first contract with the executive director who had been there for 8 years. So we had gone through that in detail. With our final recommendation really being that we recommend the authority enter into contracts, employment and otherwise only after they have been reviewed and approved by legal counsel. In addition, all contracts should be presented to the Board of Directors in their entirety, made part of the permanent record and agenda packet, and voted on by the board when form is present in accordance with the Government in the Sunshine Law. We had several real or apparent conflicts of interest. They begin on page 13, and I'm just going to very quickly. The first thing had to do with, we noted instances in which the authority voted on funding or advertising for organizations in which the board chair, new executive director, had either she was a member or on the board, and this was not properly disclosed. I want to share with you very quickly that this is you all are very familiar with the rules of that because you're public officials, but I want to read to you something that was specifically in Southeast Volusia and Authority's bylaws. It states, no employee, officer, or board member may have any conflicts of interest, real or apparent, due to ownership, other clients, contracts, or interests associated with projects that came before the Southeast Volusia Advertising Authority for a vote or in regard to purchasing goods for the authority. The board must be notified if such a conflict exists, and the officer or employee must excuse themselves from voting or purchasing from those vendors. So you can just keep that in your mind. So we did have instances where the board chair and executive director shared affiliations with organizations that the authority was voting on, event funding or advertising. The board chair and new executive director did not always disclose possible conflicts of interest, did not abstain from voting, and did not comply with the disclosure requirements of Florida statute. We further examined tear sheets, which are proof of advertisements, for 12 advertisements that appeared in the Daytona Beach News Journal from December through December as a partial result of the authority providing significant funding to a local merchants association. And in all 12 of those advertisements, the new executive director's and husband's personal business was featured prominently. However, there was no mention again or disclosure of this on the new executive sign related party confirmation, which is something that we asked for as part of our audit, and no disclosure made in accordance with state statute. We also noted a single check for $795 written to the new executive director's brother. Again, this was not disclosed on the sign related party confirmation. There was no disclosure made in accordance with state statute. That payment was verified and approved by the treasurer. Also, as part of our payroll testing, we noted that the new executive director's teenage daughter began receiving payment. This began the period June 2nd through June 15th through September 30th. The daughter was paid $5,565, which included a $2,000 bonus in July, reportedly for a PowerPoint presentation. Additional payments were subsequently made to her after year end, totaling $650, which included a $500 bonus for a grand total of $68.45 from the period June 29th through December 23rd. Again, no documentation showing board approval of the hiring of this related party, no measure of disclosure on the executive director's related party confirmation, and no disclosure in accordance with state statutes. Payments to the daughter were initialed and approved by the treasurer. We also noted in scanning for related parties that a vendor who potentially was affiliated with a company owned by the new executive director and her husband, where the vendor was Director of Design Services. Now, this is Promanta.com, a website dedicated to small business. It was a $4,000 disbursement to the vendor as of September 30th, subsequently another $69.81, and again, not disclosed in accordance with state statutes. And finally, since payments to the vendor were in excess of $3,000, it should have been competitively bid, and $125 disbursement to a cooking press company owned by the board treasurer, for which proper documentation did not exist and it wasn't disclosed. Gift cards, erroneous payments of sales tax. In a nutshell, sales tax was paid more often than it was not, especially when it related to credit card payments. Budget amendments were not handled properly. There was an error in the assistant executive director's compensation of approximately $340 in overpayments. Problems with the cutoff of expenses and backdating of checks, which made it more difficult for us to get a proper cutoff at the end of the year. Problems with the proper classification of capitalizable expenditures. They did do roughly $35,000 expenditure on the renovations of the advertising center, and those things were charged into advertising and promotion, of course, which is not appropriate. We had one check which could not be accounted for that we had requested I believe the county has already done this actually, is they stopped payment on it so that we would make sure that it was safe and not cashable. We noted two assets, Apple computer and Apple notebook. One's about $1,500, the other one $1,100 that could not be accounted for. We recommend that they follow the same policies that the county follows with regard to safeguarding of assets. The Visitor Center renovation project, in a nutshell, they spent approximately $35,000. It was approved by the board for them to spend $30,000. The problems that I have there, they spent more than budgeted, don't go back for a budget amendment. But also their bylaws indicate that any expenditure over $25,000 is capital in nature must go to the county council for approval. What we're really recommending there is that there could be some confusion what is per project and what is per vendor. So we're recommending that everybody clarify and get on the same page with regard to that. As part of that renovation, they hired independent contractors, which I'm using in quotes. As you know, independent contractors must truly be independent contractors, and it was a series of them paid just under $11,000, but no documentation could be provided of valid business licenses or insurance coverage, general liability, and workers' comp related to the contractors. And if they lacked insurance, of course, the authority was exposed to several areas of liability. In addition, IRS considers it critical that you handle that properly. So if you improperly classify an employee as an independent contractor, you could ultimately be held liable for employment taxes for that worker plus penalties and interest. Meal expenses. We had problems with a lack of documentation of meal expenses, all the required stuff. Who, what, when, where, business purpose is always required. We had instances in which we noted that meals had been provided to employees and volunteers. And again, we are bringing to your attention that more than an occasional meal is not considered de minimis by Internal Revenue Service and could be considered taxable wages to both the employee as well as the volunteer. So we really feel that except for occasionally, they should refrain from purchasing meals and snacks, and we don't believe it's a prudent use of public funds to provide them. We noticed instances in which meals were charged to the authority, totaling $647 in meals and room service charges was charged the authority credit card by the new executive director when she was already paid a per diem. You know, a per diem is you get so much per day based on the city where you're traveling. You get one, you don't get both. We recommend moving forward that it's only the per diem that is paid. And we have a comment with regard to the preparation of financial statements, which is a repeat comment. This is one that probably concerns me the least out of all of them. The other two advertising authorities had the same comment, and bottom line, what it is they don't have staff on hand at present that can prepare financial statements on a GAAP basis for a government with full disclosures, and that is really a management of, this is a management decision. It's a cost-benefit approach, whether or not you want to have somebody that high-powered in there to do that, and we are required to disclose it. Several of those comments I just talked about, in addition to being material weaknesses, were either instances that we determined to be not compliant with the law or regulation, potentially fraudulent, and abusive. In addition to that, we had a workers' comp claim. We noted the workers' comp claim was filed by the new executive director. In September 2011, it was for an injury sustained on September 16, 2011, when the new executive director aided in the rescue efforts of a beached dolphin. This claim, however, was denied on the premise that the new executive director publicly stated she was not an authority business when the incident occurred. We also noted the authority's records to indicate this date was a scheduled day off for the new executive director. Parking tickets, 2 of them were charged in as a result of them being here at a county council meeting and running late and getting a ticket. And of course that is not material. It's $18 in total. However, their bylaws specifically state that you can't charge in parking tickets. Robert's Rules of Order. The authority's bylaws indicate that the board needs to follow them, and they don't. We noted numerous instances in which Robert Rules of Order was not followed. Examples are instances in which the new executive director, although she was no longer on the board, called meetings to order, made motions voting. Also, we noted numerous instances in the minutes where there would be a discussion, but there would not be someone makes a motion, somebody seconds it, they discuss it, and they have a vote. Public records requirements, access and retention. They have to keep everything. I'm preaching to the choir when I'm telling you what those requirements are. But basically what we noted instances in which the minutes and our audio tapes of meetings couldn't be located. We also noted that the new executive director and authority board members communicated via email, using personal email addresses versus the authority system. So that makes it very difficult for the public to access it. So we're saying now you need to be on that. Contractual agreements with related parties were not handled appropriately. Credit card usage and policies. There was a lack of control related to that. We noted instances in which the new executive director was issued an authority credit card in her name while she was still on the board, and $3,600 in change of purchases was made prior to her resignation.